Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Cardinal Health is one of the three dominant pharmaceutical distributors in the United States. It moves medications, medical supplies, and specialty drugs from manufacturers to hospitals, pharmacies, and healthcare facilities across the country.
Founded in Columbus, Ohio in 1971 by Robert Walter, Cardinal Health grew through acquisitions into a company with over $200 billion in annual revenue, among the largest companies in the United States by revenue.
The revenue figure can be deceptive. Pharmaceutical distribution is intentionally a thin-margin business. Operating margins in that segment run around 0.5%. The value comes from scale, cash flow, and the indispensability of the logistics network.
The Pharmaceutical and Specialty Solutions segment accounts for approximately 96% of revenue. The remaining 4% is global medical products and distribution, covering medical supplies and devices to hospitals and surgery centers.
Cardinal Health's scale creates a genuine economic moat. Moving pharmaceutical product at $200 billion of annual volume means per-unit logistics costs that smaller distributors cannot match, a scale advantage that compounds over time.
The specialty pharmaceutical side holds the real margin expansion potential. Oncology drugs, rare disease treatments, and biologics require complex handling and clinical expertise that Cardinal's Specialty Network's business specifically targets.
GLP-1 medications for diabetes and weight management represent an emerging volume tailwind. As prescriptions grow, pharmaceutical distributors like Cardinal Health benefit directly from the increasing unit flow through their distribution network.
CEO Jason Haller came from the CFO role and has prioritized improving medical segment profitability, managing the balance sheet, and positioning the specialty pharmaceutical platform for long-term growth.
The 2021 opioid settlement required Cardinal, alongside McKesson and AmerisourceBergen, to pay $6.4 billion over 18 years to states. That liability is now largely absorbed into the financial model and no longer dominates investor concern.
Competitively, Cardinal operates in a three-player oligopoly with McKesson and Cencora, the company formerly known as AmerisourceBergen. All three distribute at scale, and the barriers to entry for a new national competitor are essentially insurmountable.
Cardinal has raised its dividend for 39 consecutive years. The yield runs near 1.8%, with approximately $580 million returned to shareholders annually, anchored by the predictability of pharmaceutical distribution margins.
The footprint serves over 90% of U.S. hospitals and pharmacies. That coverage density makes Cardinal essential. Hospitals cannot swap distribution partners without significant operational disruption to their medication supply chain.
The long-term story is about shifting from volume toward value. As the specialty segment grows and generic distribution automates, Cardinal's earnings mix should move toward higher margin, more defensible revenue streams.
Cardinal Health is the backbone of American healthcare. Invisible when it works, critical when it does not. The scale, relationships, and 39-year dividend track record reflect a business built for durability.
That's the company chapter for Cardinal Health. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Cardinal Health just printed a quarter that perfectly captures the pharmaceutical distribution story. Q3 fiscal 2026, revenue up 11% to $60.9 billion. Non-GAAP EPS came in at $3.17 versus the street's $2.79, a 13.6% beat and 35% year-over-year growth. Management raised full-year guidance. GLP-1 distribution is on fire. This is Charged Alpha. Let's break it down.
Cardinal Health is one of the big three U.S. pharmaceutical distributors, alongside McKesson and Cencora. They sit between drug manufacturers and the hospitals, pharmacies, and health systems that ultimately dispense medication. The Pharmaceutical and Specialty Solutions segment is the giant, $56.1 billion in quarterly revenue. The medical segment sells surgical gloves, lab equipment, and medical surgical supplies. Together, they form essential national healthcare infrastructure.
Here's the structural fact that drives everything else. Pharmaceutical distribution is a low-margin, high-volume business. Cardinal's gross margin is 3.6%. That is not a weakness. That is the model. Distributors earn pennies on every dollar of pharmaceuticals moved, but they move staggering volumes. On nearly $282 billion of forward revenue, those pennies compound into roughly $5.5 billion in trailing free cash flow. Thin margin, massive cash.
Let's walk the Q3 numbers. Total revenue was $60.94 billion, up 11% from the prior year quarter. That came in slightly below the street's $61.7 billion estimate, a roughly $760 million miss. Non-GAAP diluted EPS jumped 35% to $3.17, beating the $2.79 consensus by 13.6%. The bottom line beat is the headline number that matters.
GAAP results tell a different story. GAAP operating earnings fell 30% to $509 million, and GAAP EPS dropped 20% to $1.69. The gap between non-GAAP and GAAP is a $184 million pre-tax goodwill impairment on the Navista and ION reporting unit. That's an accounting write-down on previously acquired specialty oncology assets, a real charge, but not a recurring operational drag.
Segment breakdown is critical. Pharmaceutical and Specialty Solutions revenue grew 11% to $56.1 billion, driven by brand and specialty pharmaceutical growth from existing customers. Specialty distribution alone was up over 20%, with the Cemexis patient support platform onboarding new therapies. The medical segment is the smaller piece but operates at higher margins when running well.
On gross margin, 3.6% sounds tiny, but apply it to $282 billion in annual revenue. That's roughly $10 billion in gross profit dollars. Distributors compete on operational efficiency, scale, and contract terms. Cardinal's structural margin is consistent with McKesson and Cencora. This is how the entire industry works. Don't compare it to a software company. Compare it to the absolute dollar gross profit.
Cash generation is the story. Trailing 12-month free cash flow stands at $5.5 billion. Management raised the fiscal 2026 adjusted free cash flow guidance to a range of $3.3 to $3.7 billion. With $2.8 billion in cash on hand against $9 billion in total debt, the net debt position is manageable, especially given the consistent cash conversion.
Capital return is aggressive. The company completed its second quarter accelerated share repurchase in January, then launched and completed an additional $250 million buyback in Q3. Year-to-date fiscal 2026 buybacks now total $1 billion, $250 million above the baseline target. Add the dividend yield around 1%, and Cardinal is returning capital meaningfully to shareholders every quarter.
Wall Street coverage is decisively positive. 13 analysts rate Cardinal a buy, 3 are at hold, and 0 recommend selling. That's a strong buy consensus by any reasonable framework. The average 12-month price target is $248, with a high estimate of $275 and a low of $200. Against the current quote near $193, that target implies roughly 28% upside on consensus.
Recent analyst activity supports the bull thesis. William Blair initiated coverage at Outperform, calling Cardinal a, quote, stealth compounder, built on a robust pharmaceutical distribution framework with high-growth specialty opportunities. Wells Fargo reiterated buy in mid-April. Evercore ISI maintained Outperform but trimmed its target from 260 to 240, reflecting some near-term tariff caution.
Valuation is the value story. Forward EPS for fiscal 2026 now sits in the $10.70 to $10.80 range after the guidance raise. At $193 per share, that's roughly 17.9 times forward earnings. For a defensive, recession-resistant healthcare infrastructure business with $5.5 billion in free cash flow and a strong buy analyst chorus, that is a reasonable multiple, not expensive.
Beta is 0.65, which means Cardinal historically moves only 65% as much as the broader market. That low beta profile is exactly what defensive healthcare buyers want. In a risk-off environment, distributors keep moving drugs because patients keep needing medication. The business cycle barely touches them. That defensive character supports the multiple even when growth decelerates.
The bear bristles at one number, though. Revenue missed the street estimate by about $760 million. Some analysts see that as a deceleration signal. The bulls counter that the EPS beat, plus the raised full-year guidance, non-GAAP EPS taken from a 10.15 to 10.35 range up to 10.70 to 10.80, proves operational leverage is improving even as top-line lumpiness persists. Both views have merit. The guidance raise is the swing factor.
The bull case has three pillars. First, GLP-1 distribution volume. GLP-1 revenue grew over 30% and contributed 6 percentage points to total revenue growth this quarter alone. As Ozempic, Wegovy, Mounjaro, and Zepbound continue scaling, Cardinal moves every prescription. That's a multi-year tailwind.
Second, specialty pharmaceutical distribution. Specialty grew over 20% year over year. Specialty drugs, oncology, rare disease, immunology, carry higher margins than generic pharmaceuticals. As the drug pipeline shifts toward specialty and biologics, Cardinal's mix improves. The Cemexis platform onboarding new therapies is the strategic centerpiece of that pivot.
Third, raised guidance and capital return at scale. Management took fiscal 2026 EPS guidance up by roughly 55 cents at the midpoint and lifted free cash flow guidance materially. With $1 billion in buybacks already completed year to date and $250 million above the baseline plan, the EPS compounding flywheel is running. That's a durable shareholder return mechanism.
The bear case starts with the revenue miss. $60.9 billion against a $61.7 billion estimate is a real shortfall, even if the bottom line beat. If the next quarter shows a similar pattern, the market may begin questioning whether GLP-1 contribution is being offset by pricing concessions in legacy pharmaceutical distribution.
Inflation Reduction Act WAC pricing adjustments reduced Q3 revenue growth by 6 percentage points. That is essentially a federal pricing offset that fully cancels the 6 points of GLP-1 lift. So while GLP-1 is generating volume, it is being partially neutralized at the revenue line by drug pricing reform. Investors need to track whether this offset persists or fades.
The Navista and Ion goodwill impairment of $184 million is a yellow flag on the specialty acquisition strategy. Goodwill write-downs typically signal that an acquired business is underperforming its purchase price assumptions. If Cardinal's specialty pivot is the long-term margin story, an impairment in that segment deserves close attention on subsequent calls.
And the opioid settlement liability tail remains. Cardinal, McKesson, and Cencora all carry multi-year cash payment obligations from the national opioid settlement. Those payments are material to free cash flow over the settlement window and limit how aggressively management can lean into buybacks or new acquisitions. It is a known headwind, but it does not go away.
Cardinal's natural peer group is the other two members of the Big Three, McKesson, ticker MCK, and Cencora, ticker COR, formerly AmerisourceBergen. Walgreens Boots Alliance, ticker WBA, sits adjacent as a major retail pharmacy customer and competitor in some channels. These three distributors collectively control over 90% of U.S. pharmaceutical distribution volume.
Versus McKesson. McKesson is the largest of the three by revenue and trades at a higher forward multiple, reflecting its broader specialty platform and its U.S. oncology network. Cardinal trades at a discount to McKesson historically, partly because of the medical segment's volatility and partly because McKesson has executed more cleanly on specialty over the last 5 years.
Cencora, formerly AmerisourceBergen, has the closest revenue mix to Cardinal and is the most direct comparable. Cencora has been growing slightly faster on the specialty side recently, but Cardinal's raised guidance this quarter narrows that gap meaningfully. All three carry similar structural 3 to 4% gross margins because the industry economics are the same across the board.
Cardinal's moat versus everyone else is scale plus distribution infrastructure. The cost to replicate a national pharmaceutical network is prohibitive for new entrants. Regulatory licensing alone is a multi-year barrier. Inside the Big Three, competition is on contract economics and specialty capabilities. The stealth compounder narrative is about operating scale efficiently while leaning into specialty.
Options activity around the Q3 print was roughly aligned with realized movement. Implied volatility ahead of earnings was pricing about a 5% move on the report. The actual close-to-close drift from 202 to 193 landed near that range. Premium sellers who positioned around the print captured typical post-earnings IV crush, a pattern that repeats almost every quarter for this name.
Longer-dated open interest skews bullish. Call activity in the January 2027 series clusters around the 220 and 240 strikes, consistent with positioning toward the analyst average target. Put activity at 180 and 175 appears to be downside hedging by long holders rather than directional shorting. Net positioning reads like long and hedged rather than bearish.
Insider activity has been routine. Cardinal executives sell shares through pre-scheduled 10b5-1 plans, which is standard at large healthcare companies where leadership receives substantial equity compensation. There has been no unusual cluster of insider selling around the Q3 print, and no notable insider buying either. The signal from insiders right now is essentially neutral.
Institutional ownership is north of 90% of the float, which is the highest tier. Vanguard, BlackRock, State Street, and major active healthcare funds all hold meaningful positions. That ownership profile means Cardinal trades on fundamentals and analyst flows, not retail momentum. Earnings beats and guidance changes drive the tape. Meme-style volatility is essentially absent here.
Bottom line on Cardinal, defensive compounder with a real GLP-1 and specialty tailwind. Revenue missed slightly, but the EPS beat and raised guidance matter more. At 17.9 times forward earnings against a 248 target, valuation is reasonable.
The stock sold off 5% on the print, and that pullback is the entry point bulls wanted. Charged Alpha rates this a watchlist ad, thin margin, massive cash, durable buyback engine. Track GLP-1 trajectory next quarter.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.